Thank you, Mr. Chairman, for calling this very important hearing and for all of our presenters here today. It's a very, very important topic. I strongly support the Volcker Rule, and I believe it stands for an important principle that banks should not gamble with their customers' money, especially when that money is backed by a taxpayer guarantee. We have seen too often in the past how that produces a situation where all the profit is privately shared while the risk is borne by the public. The Volcker Rule, which was named after a great New Yorker, former Fed Chair Paul Volcker, came into effect in July 2015. So this is a good time to take stock of how this rule is doing. Today I have some data from the Federal Reserve that will shed light on how the implementation of the Volcker Rule is going. Under the rule, banks are required to report a series of quantitative trading metrics, in other words, hard data, to the regulators, such as risk levels on each trading desk, in order to help the regulators identify any prohibited proprietary trading or trading for your own account. Last August, I sent a letter to 5 agencies in charge of the Volcker Rule, requesting that they provide me with an analysis of these trading metrics, which they've been collecting from the banks since July 2014, over 2.5 years. And I'd like to place that letter into the record. The Federal Reserve has been very helpful with my request and has provided me with an analysis of some of the data that they collect. So this data is limited to the data that the Fed collects. It does not represent any other agency's data. And I want to share this data with everyone today because I think it's important. It's the first hard data we have on the Volcker Rule. It's complicated, but it is extremely important. As you can see on the screen, the first 2 charts show that risk levels on banks' trading desks have been largely steady since the Volcker Rule took effect. All of these big downward spikes in the chart represent holidays, like Thanksgiving or Christmas, when most markets are closed. So this is not something to worry about. Importantly, these charts cover 2 periods of market stress. The Third Avenue Credit Fund's suspension of withdrawals in December of 2015. A headline in Bloomberg back then read, "Third Avenue redemption freeze sends chill through credit market." And the second period of stress was the China growth scare, when China's economic growth suddenly slowed down in January and February of 2016. A headline in Forbes at that time asked, "Should markets be scared?" The charts show that the banks did not pull back from the markets during these 2 periods. In fact, they increased their exposure during these episodes. Next, we have a very interesting table that shows the so-called Sharpe ratios on banks' trading desks, broken out by asset class. What this table suggests is that banks are now making the vast majority of their money on trading desks from legitimate market-making activities, which the Volcker Rule allows, and not from inappropriate proprietary trading. The Sharpe ratio is a widely accepted way of measuring risk-adjusted returns for banks. In other words, it measures the returns that the bank's trading desks are getting on these asset classes relative to the amount of risk they are taking, which is important because you can always get higher returns by taking more risks. So we need a way to adjust for the risk level so we can compare performance. The higher the Sharpe ratio, the better the returns relative to the risk. Now, the most interesting thing is the difference between the Sharpe ratios for new positions, existing positions, and changes in risk factors. If banks were still doing a great deal of proprietary trading, then they would be getting a lot of their returns from existing positions or possibly from changes in risk factors. In other words, if banks were making proprietary bets that the price of a particular security would increase, then they would be getting most of their returns from price appreciation for securities they already bought, which are existing positions in this table. But as you can see, the Sharpe ratios for existing positions as well as for changes in risk factors, have averages very close to zero. This suggests that banks are not engaging in any amount of proprietary trading. Instead, the table shows that the banks are mostly profiting from new positions. This suggests that trading desks at banks are making most of their money by acting as legitimate market makers, which is exactly what Congress intended to happen under the Volcker Rule. In other words, most of the bank's profits are coming from the fees, also known as the spread, that banks collect on trades they do with their customers. These fees are collected up front, which is why most of the bank's profits are coming from new positions. So I wanted to share this data with everyone here today because I think it's relevant to this hearing. It's important that we look at hard data, the facts on the Volcker Rule, and based on this data, I would say the Volcker Rule is working. I look forward to your testimony.
Gentlelady's time has